Hey everyone, today on the final bar, my guest is Bogomazov from Wyckoff Analytics. Wyckoff is such a fascinating way of structuring your market analysis. I'm excited to hear what Roman thinks about the current market environment. I was, again, as usual, had this great plan in mind of how we were going to approach the show. And then the last 30 minutes, 60 minutes, we had this huge distribution. So we're going to look at some of the charts and see how today's sell-off is starting to line up with some of the themes we've talked about up until today. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to break down the market activity through the technical lens, try to connect today's movements to the larger term trends, the momentum, the breadth, the sentiment, all those tools that are going to help us understand the long-term trajectory of markets. And, as we've talked about this in recent weeks, just dealing with this whole bear market rally situation, the last week or so has really been more of a stabilization, even the last 2 weeks, where we had this huge V bottom and now things starting to differentiate a little bit. And yesterday, we talked a lot about how some sectors like healthcare, consumer staples, starting to pull back a little bit along with financials, others like tech and others, sort of continuing in a position of strength. And the question is, what's next, right? Are we going to have enough strength to push above S&P 3000 going to new highs? Or do we start reverting back and continuing this larger bear market that so many are expecting? And today felt like sort of a continuation of that stable period until we had the distribution going into the close. So again, we'll look at some of the charts together, dealing with the S&P down over 2% today. Coming up on this show, we have some fantastic guests like Roman, my guest today. Others this week are Sam Stovall from CFRA Research. He'll join us tomorrow on May 13th. And then on Thursday, May 14th, Tom Boley from Earnings Beats. Next week, we have some great guests as well. Todd Campbell joining us from the Boston area. I've known him for a number of years back from my Fidelity days. And then Doug Bush, coming from the New York area from Chart Smarter, is going to join us on Wednesday the 20th. Also, a little later, we're going to record our next episode of The Pitch that's going to premiere tomorrow. That is one of our newest shows. It's a monthly broadcast featuring a StockCharts moderator. So Grayson Rose from StockCharts is going to moderate a discussion with three strategists sharing, really pitching their ideas to you in terms of stocks and ETFs that they see have good potential going forward. So don't forget to check out The Pitch coming up tomorrow, Wednesday the 13th. So as we think about our market recap today, again, at times I'm not sure why I plan too much for this show, because it's best to just turn things on right beforehand and just see what happened, because so many things seem to evolve. And that last 30 to 60 minutes we've talked about many times really shows you the direction of a number of things. That last period is when a lot of the big institutions are going to put in trades. And so a lot of times there will be programs that kick in. There will be huge moves that then sort of feed on themselves. There's a feedback loop that causes severe moves. In the end, it's also a lot of ETFs. That's where they might have to be taking or changing positions at the end as well. So today you certainly had what started out as a relatively flat day, sort of trading around 29.30, which was yesterday's close. You sort of came off, and the last hour really sold off, and the close was the best thing that happened to this market today. The S&P finishing down right around 2870. That's down over 2%. Mid caps, small caps down even more. So we continue to have this pattern of small cap distribution, mid cap distribution. Again, there have been stretches where mid caps and small caps have really been stronger during the day, but today's certainly not the case. This is more of a risk averse sort of move. The VIX higher up to 32, again, still on the relative, if you look at the long-term trends, it's still a relatively volatile environment compared to where we were, over 80 about 6 weeks ago. We're not that extreme, but still relatively elevated. In terms of some of the markets, and we're going to get back to a chart of the S&P 500, bonds stronger today. So the TLT up 1% going to 164. The dollar was actually flat for the day, remaining around 27 for the UUP, the dollar ETF. In terms of commodities, actually a lighter move for commodities. They weren't really the story today, but gold was up a handful, up over 1/3%. The GLD up to 160. Oil actually finishing lower. Natural gas, gasoline, all lower today. So overall, the commodity complex weaker today, with the exception of gold that was a little bit stronger. Let's look at a chart of the S&P 500, then we'll try to hit on some of the other themes here. So this general thesis we've been talking about is this congestion area around 2950 to 3000, and that hits on a number of different points. So this is where the S&P peaked out about 2 weeks ago. This is on that last gasp higher. It pushed us right above that 61.8% retracement of the February to March sell-off, and above there we have the 200-day moving average right around S&P 3000. So we have this confluence of resistance, this series of indicators all giving us similar levels right here. And so for many, and myself included, if this is a bear market rally, this is about where you'd expect it to top out. What's happened since the pullback that we saw last week is we've now rallied back in, bounced off the 2800 level, back up to right below 2950. Today we have a bearish engulfing pattern, which is a higher open, a lower close, where today's body engulfs the previous body. And if you look at a candle chart, you'll see why it's called that, where the big candle, the body of the candle, engulfs the previous day's range. And essentially that's a short-term bearish signal telling us to expect some weaker moves in the next couple bars. This coincides with the RSI never really getting above 60, which is pretty classic for a bear market environment. So today certainly validating in some small way a weaker tape to be expected based on reaching that sort of proposed peak of a bear market environment. Let's go back to the market recap, to the dashboard. In terms of sector performance, everything down today. Staples, utilities at the top of the list, followed by healthcare and materials. That's where gold stocks are. So things like Newmont Mining and others. So it's really the defensive plays that were up at the top. At the bottom, you had real estate, which is one of the more defensive, higher yielding sectors. That's kind of an interesting stock to be at the bottom. But a lot of those are things like retail, things tied to malls and retail facilities, office spaces. So understandable that if we're sort of mentally dealing with the world might take longer to recover. That's certainly what's at the bottom, followed by industrials, financials, consumer discretionary, tech, communication services, and really those bottom three were the big underperformers today. And again, what causes these movements? There's so many. I mean, as always, the markets are a mosaic of sentiment. It's how we're digesting all the news. As I was going through preparing for the show, seeing things like Los Angeles talking about extending their stay-at-home order for the next 3 months, headlines like that, any difficulties with reopening, trying to get things quote unquote back to normal, certainly going to put pressure on equities, and it's going to hit REITs. It's going to hit these other stocks that would do well if the economy recovers very quickly. In terms of stocks on the move, it's actually interesting to see a lot of energy names pumping up in the scooter rankings today. So you had Devon Energy, Marathon Oil, all popping up toward the top of the list here. Duke Energy, DUK, as well. The number one gainer in the StockCharts technical rating was actually in materials. It's AMCR, Amcor, which is in the containers and packaging group. And it traded above its 200-day moving average, but never really followed through. It actually finished more toward the lows of the day. So even stocks gaining today weren't dramatically rallying. I mean, they sort of came off going into the close. It felt like sort of everything pulling back a little bit. In terms of stocks down the most in the form of losing in their scooter rankings, Ulta Beauty, ULTA, was the number one loser in the scooter rankings, down 8% today. This is when specialty retail, and again, sort of a nice down bar today. And again, with a lot of these stocks, the challenge is it's trend lines you drew from the March and April lows really have already been broken. But now it almost appears like if you drew a trend line, you rallied back to the trend line and now potentially falling through to the downside. So today may be the beginning of a little further pullback in things, which I think would be really interesting to see. Most concerning to me was seeing BlackRock on one of the biggest losers in its scooter ranking. And so this is within financials. This is an asset manager. We didn't talk about BlackRock yesterday, but we did talk about Franklin Resource. I want to say BEN yesterday, as we were doing our shifting stock segment. some of the asset managers have actually lined up pretty well. BlackRock has been one of the stronger ones. Relative strength actually had made a new relative high last week in April as the stock regained its 50 and 200-day moving average. But now all of a sudden, it's established a lower peak and now has made a lower low. So all of a sudden, you have this stock in a tactical uptrend. BlackRock now in a tactical downtrend, lower highs, lower lows. And the more stocks that have that sort of pattern, the more concerned I would be. The relative strength now testing a new 6-week low. And again, if you see stocks like BlackRock continuing to follow through to the downside, it would make me a little bit concerned about the overall environment. And again, peppered around, you had a lot of stocks distributing. And again, it's going to take some time to look through some of these charts and see sort of the potential impacts of them. But it's amazing how one bar, this is Akamai Technology within communication services, down 6%. So a stock that had actually looked like it was building momentum to go and retest the previous high around 108. All of a sudden in one bar, all of a sudden this looks like a lower high. And now you're looking at the swing low. So with any of these charts, if these are stocks that you own or that are on your watch list, I wouldn't be super concerned yet. I would be super concerned if you start to break down through the most recent swing low. What I mean is sort of back out mentally, look at the peaks and valleys. You've now established a lower high. Do you break that lower low? And if so, then you really have to start questioning whether or not you should remain in that type of name, or whether you want to revisit other places. If you remain above those swing lows, that tells you this is just a pullback within a short-term uptrend. Only other thing I'll point out, and then we need to move on to our next segment, is yesterday we talked about within financials, just a couple random bright spots, and one of them were insurance companies. Actually, insurance brokers, one of the only two industries out of 100 plus in our universe that was actually up today. So the insurance brokers group up. So again, on a big down day, always interesting to see what is actually working and dig in there and see if there are some patterns on those charts worth taking a deeper look at. That's our market recap for today. We need to take a quick commercial break. Be back with my guest, Roman Bogomazov. We'll see you in a minute. Hello, everyone. Welcome back to the show. This is your host, Dave Keller, here at StockCharts.com. Thanks for joining us every weekday for the final bar. As a reminder, we're going to do a mailbag segment momentarily. And I'd remind you, just shoot your questions to us via email. thefinalbar@StockCharts.com is the best way to get your questions to us. We received so much great feedback on the show and a lot of great questions about individual charts, about market dynamics, about investor behavior, technical indicators, whatever it is. Shoot it to us. We'll do our best to address your questions on the air. We're so fortunate to have some really knowledgeable experts joining us on the show, and today is one of the best. Roman Bogomazov. Roman's an expert in Wyckoff analytics, Wyckoff analysis, which is a very disciplined way of analyzing investor behavior. So, Roman, thrilled to have you back on the show, my friend.
It's always such a great pleasure for me to come back. Thank you, Dave, for having me.
Of course. So you sent a chart of the S&P 500. It's a 180-minute chart. So it's sort of that sort of short-term, medium-term time frame looking at this inflection point from the market bottom to where we're at now. From a Wyckoff perspective, can you break this down for us?
It's really hard to see the actual causality that at the bottom of the decline. So it's better go to the intraday chart and to see the structure right there. And we could see how on around March 12th, we had the first change of behavior after the sell-in climax. That automatic rally had a very, very bullish, constructive behavior into the announcement of the national emergency. And then we had a couple of secondary tests at the lows, and then the sprint into phase C. So on the intraday chart, a much better look into the cause. And because of the volatility, if you look at the PNF chart, you could see how that cause has been created with columns up and down, up and down. Then a very significant change of character on a sign of strength, a backing up action that is flat in nature. So this is where we are observing and change of a structural change of character. This is where we're saying that the decline is over and we are going up. And obviously that first momentum kickoff since the low of March 23rd has a lot of momentum, and that momentum continues into the beginning of April, and look what happens next. Momentum slows down, and there are a lot of talks, in the media and just, in our technical world, technical analysis world, about deterioration of the momentum, deterioration of the volume signature, deterioration of the demand, deterioration of the breadth. But those conditions really the conditions where the reversal is going to happen and we're going to go down? Not necessarily. And I think that was kind of like the struggle for a lot of us, including myself. So the key takeout from all of this rallying mode that I took for myself, Dave, was don't fight the tape. If the price is going up, then just go with that. But something very, very interesting has happened today, as you've mentioned at the beginning of the show. We were at the lower high, and if we would have failed and we would go through 2885 on the S&P, we would have confirmed a lower high, and I think we did, into the close. So that was kind of my statement coming into the show. If we are still holding here, we still could have higher objectives. We still have the bullish stride of the trend. And then if we fail here, this was the vulnerable spot, and we did. So kind of very interesting look at how it happened into the close.
So it is really interesting. And so, I think where a lot of people struggle is, today certainly felt negative, right? You had a lot of distribution going into the close, but you made a great point, which is paying attention to the trend, right? Don't fight the tape, don't fight price, follow the price. How do you keep a proper perspective on the long-term trend and not get too caught up into today's trading, right? How should we try to put today's sell-off into proper context? Is there a certain level or a certain continued pattern that would give you further conviction of further downside, or how would you think of it?
Obviously, just looking at the high time frame. So here we're looking at the intraday picture, but going to the daily, going to the weekly, and looking for the reversals there. And by the way, into the close on the daily, we had the reversals everywhere: S&P, NASDAQ, Dow, Russell. So this is something that is a little bit more significant than the reversal that we had on April 30th, because April 30th was a higher high in NASDAQ, in the leading sector. And we are reversing now from the lower high. That's a big difference. That's a contextual difference right there. And NASDAQ obviously leading there, with the higher highs. I meant to say S&P, Russell, and the Dow. So
Right.
as NASDAQ is leading, we're expecting that it's going to up thrust and then reverse. Whereas the lagging instruments are going to reverse probably from the lower high. And I think the timing is just right here, right now.
It's interesting. People have talked so much about the strength in technology, and I've certainly noticed, if you look at the Qs or you look at the XLK or something like that, technology has tended to do well in any environment. It's outperformed in bullish environments. It's outperformed in bearish environments. So even though the S&P has started to falter just a little bit, you look at this chart, you look at the QQQ, and it just continues to go up unabated. So, if you were looking at one chart besides the S&P, would it be something like this? Would it be technology? What would you use to sort of validate what you're seeing on the S&P chart? Any specific ideas there?
Let me just kind of throw a suggestion right here about what possibly or how possibly this reaction could unfold. I usually look a lot at the character of the selling that comes in. Sometimes we have a lot of selling, but that's just profit taking. And today it felt like it was so urgent and so aggressive and into the close. So character is one of the things that I definitely look on the daily basis. And just, looking at the NASDAQ and how strong it is, I think if the reaction unfolds, it doesn't really mean that we're going to go and retest the lows of March 23rd. We're probably going to have a significant reaction, but still NASDAQ is going to be leading, after that reaction. That's kind of like the leadership resumption that I would be expecting.
Ramon, we have to move on. This was so great to have you on. Thank you for sharing the perspective. And again, what I love about Wyckoff analysis is it talks about the behavior, talks about, the nature of these price movements. And I think your comments are very, very well received. Ramon Bogomazov, thanks so much for coming back on the show.
Thank you so much.
That was Ramon Bogomazov from Wyckoff Analytics in the San Francisco Bay Area. And congrats again to Ramon with a 1-year-old, surviving as all of us are, getting through this period. But great to have him back on the show. And again, what I love talking to people like Ramon, if you hear about it, he connects the price movements, what we're seeing on the the 3-hour chart or the daily chart, but connects it to the behavior. What do the price movements tell you about the underlying investor behavior, which speaks to me very, very deeply. So really cool discussion. We need to move on though and go right to our final bar mailbag. So again, one of my favorite parts of the show is to answer your questions. And so we have a couple of them lined up. As a reminder, you can get them to us two ways, via email, thefinalbar@stockcharts.com, or on Twitter @finalbarsctv. Just tag us in a comment and we'll get to it as soon as we can. First question, dear Mr. Keller, I have a doubt. Thanks for calling me Mr. Keller. That's very kind. I have a doubt with regard to correlation between the index and individual stocks. I'm paraphrasing just a bit for time. The index loses more than 1%. The individual stocks are also going down. Some of them are in clear uptrends until the previous day. When the index starts to go down, the individual stocks are taking a beating as well. So do I need to sell my individual holdings when the index starts to fall, or should I be buying more as that particular stock is coming at cheaper prices? Boy, that's such a fascinating question. And again, I'm going to attempt to answer it in as best as I can in just a minute or two. But you've hit on a really fascinating point, which is what happens when the index starts going down. And today may be, again, based on what we just heard from Roman and based on what we have talked about on the show, we're at that resistance level. I think it's fair to expect some downside, at least a pullback, in U.S. equities for sure. So what does that mean? What do you do with a broad market position, the S&P, the Qs, some of the diamonds, or individual stock holdings? And I think that's where, to be honest, I think your use of charts there becomes really, really important. If and when the market as a whole starts to sell off, let's say the S&P goes down to 2650, for example, and I just picked that out of nowhere. If that happens, certain stocks are going to come back a lot less. Certain stocks are really going to capitulate and go down. So what I like to do is look back and see which stocks have held up very, very well. I asked Ramon, my guest, just earlier about technology. And I think if you look at the XLK, you look at the consistent outperformance in technology when people have been optimistic. They've been flying to biotechs, they've been flying to technology, things like Zoom and Shopify and others. They've been going to Amazon, they've been going to all of these different sorts of names. The question is, when the market sells off, where are people going to go if they still want to hold equities but want to be in stable, safe positions? And it's going to be, I would assume, things like big mega cap tech, which has done well in previous downturns over the last couple months. So Apple, Microsoft, even just the XLK, I would expect in a downturn that those would continue to outperform, meaning it's going to cushion you on potential downside. So depending on what market you're looking at, if you're looking at the US market or the Indian market or whatever your Canadian market, I would focus on what stocks have done well in previous downturns and look in particular year to date and when the market sold off and when we had the recovery, what sort of held up pretty well. And I would lean on places like that have been able to hold up pretty well. Things that have had a V bottom that were more optimistic, the world's going to get better. Those could be some of the quickest ones to roll over. And it's things I think like retail types of names that might have spiked a little more than maybe they should have. Really, really good question. It's very interesting to think about the relationship between the broad index and individual stocks. That's a whole separate discussion we can have someday about money management, how to think about your core, what Gaddis Rose, my fellow StockCharts contributor, calls the core and explore model. It's worth looking up if you don't know what if you're not familiar with what I just said. Question number 2, I mentioned on my show the market may retest the March lows. Agreed. If you look at the chart of the S&P, it looks like there's a lot of resistance around 2950. It seems like an accurate assessment. I accept your kudos on that level. Thank you. But if you look at the Qs, what a great question. It looks like the market has no resistance in making new highs, and that's a great point. Here's what happened, right? Up until this, about 3 weeks ago, everything looked very, very similar. Everything sold off from February to March, almost everything. And almost everything had a V bottom and came back. Over the last 3 weeks, we talked about this yesterday. We talked about this on Friday's show in particular. If you look at especially the 11 S&P sectors, you will see some sectors that have actually continued to go up, things like technology, communication services. You've seen things that have actually pulled back, things like consumer staples, utilities, real estate, even some healthcare stocks as well. The S&P is sort of flat, really. So now it's established this range between 2,800 and 2,950. This is in some ways the easiest market to trade, to be honest, because either you break out of resistance to the upside or you break down through support. And more often than not, that direction of the breakout, that direction of momentum is where you want to follow it. Now you're comparing that to the chart of the Qs, which you looked at with Ramana a few moments ago. And this actually looks very different. This actually continues to go to higher highs and higher lows. So while the S&P was relatively stable, the Qs were actually increasing, actually making higher highs. And so what happens there is what's next, right? How do you declare resistance? So I think what you need to do is look at the broad market environment, look at the broad S&P as sort of your overall gauge on what's what, and then look at the individual components on there. What we've seen is that the Qs, technology, have been resilient. They've actually broken to new highs, broken to new swing highs, while the broader market has been holding steady. I would be looking at a chart of the Qs and see if we start to make a lower high, we make a lower low. I wouldn't be surprised if that happens much after the S&P because it's been leadership. I think it's also going to be more of a safe haven in any sort of pullback. And so in general, the S&P is the main thing I would look at. I'm then looking at all the other indexes, all the other cap tiers, all the other charts to try to identify leadership and laggardship within that overall market trend. That was sort of a roundabout answer to your question, but I hope that that's helpful. When you're looking at the market, depending on how you look at it, when you look at the S&P or the Qs or the Russell 2000, you're going to get a bit of a different perspective, but agreement or disagreement between some of those different charts can be really, really valuable. We need to move on and finish the show going to our 3 and 3 charts in 3 minutes. Here we go. Chart number 1. And this is building on my last question. I couldn't have scripted that much better, and I didn't do it on purpose. This is looking at Dow theory, looking at the Dow Industrials versus the Dow Transports. This is a very traditional way of tracking overall market trends and market stability. And the idea is the producers of goods and the distributors of goods, are they in agreement? Now, this was created 100 plus years ago when the Dow Industrials and the Dow Railroads were very different things. And it was literally the way you produce companies that produce goods and the companies that distribute goods. These indexes have changed form in many ways, but I still know many people that use them as a way to measure overall market strength and market stability. This would be another way to sort of validate a potential breakdown, is if you get the Dow Industrials and the Dow Transports confirming a breakdown through their most recent swing lows. And for me, it's sort of that third week in April, that swing low here. If you get to see the Dow Industrials and Transports break through there, I think you can confirm a valid breakdown overall in stocks. Chart number 2 is a chart of the GLD. This is gold. And again, it's been a relative underperformer. And I don't like to say gold is going to work just because it's a safe haven. I would prefer to analyze the price itself. So at this point, it's been relatively stable. It sort of had this pennant pattern, this nice run, and then lower highs, higher lows. I'm waiting to see which way this breaks. If and when it breaks to new highs, breaks above this resistance level, taking the peaks from the last month or so, I think that would be significant and speak to a potential further next upside for gold. Our final chart is the McClellan oscillator, and again, is another way to validate what we're seeing with the S&P 500. I think you can look at a chart of the McClellan oscillator, because what it basically does is it shows you the overall breadth picture. This is taking advanced decline lines, but it's smoothing them out with exponential moving averages. If this line is above 0, it tells you the breadth overall is constructive. If it goes below 0, it would tell you it's starting to be less constructive or be more negative. It really turned negative here in January to mid-February. Was unable to get above the 0 level in February. That ended up being the market peak, although a lot of stocks peaked back in January, went well below 0, came back above the 4th week in March, and for the most part has remained above there. If and when the McClellan oscillator breaks back below the 0 level, I think you could be a little more concerned about potential further downside in stock. So that's our show for today. We're at such a key pivotal level, and I'm excited about today's sell-off only because it potentially gives us a little bit of clarity about where we might go next. I think the weight of the evidence suggests some short-term further downside, and all eyes going to be on the most recent swing lows on a lot of charts to see if we violate that support. Special thanks to my guest, Roman Bogomazov from Wyckoff Analytics, for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.